Well, good afternoon. Good afternoon and welcome to another of our Managing Your Small Business Through the Pandemic webinar. This is number 42 in our series that began back on March 18th, our 42nd webinar in our 7th or 8th webinar season. We've been doing them since 2014. Well, good afternoon. My name's Kelly Bearden. I'm the director of the CSU Bakersfield SBDC, and it's a pleasure to have you along. We've got so much content to go over, so many changes, so much law, so much happening for such a quiet time of year. A time when I spoke to our guest, Dr. Richard Gearhart, about this webinar a few weeks ago, it seemed like it was a lot different than it was going to be. We were going to have a nice, peaceful talk about a lot of our hard-hit industries and really go into detail. And instead, we have a stimulus program, a new state grant going live today, and all kinds of other things to share with you. So let's get going. As you know, we're part of America's SBDC. Here in California, we have 5 regions. We're part of the Central California region. The Central California region is 14 counties that goes from the top of Mono County down to the bottom of Kern, over to the Pacific Ocean to the state of Nevada. 14 counties throughout the Central California region. So we have our office in downtown Bakersfield, and we're affiliated with offices in Clovis, Merced, Modesto, Salinas, and in San Luis Obispo. So if you have any business needs, any questions, contact your local SBDC. They are there to help and are open throughout the pandemic. So as you see, we are actually with our 14 counties and 2 extra ones that are there for no reason at all. You'll see that we serve all of Kern, Inyo, and Mono counties, an area of about the size of about 8 states, larger than 8 states in the United States. So very large geographic swath of some very diverse and interesting businesses throughout our particular region. Webinar Wednesday, we have a variety of different sponsors that make it possible. Thank you to all of them. And let's get going. So what's new today? What's new today, December 30th? Well, I know one thing that's new. This is the last webinar of this year. And you'd think it would have been a little slower, but it's not. So we're going to talk about the California Relief Grant Program that opened this morning around 6 a.m., a program from the state of California, and we'll go through and go that quite a bit. It's only open for about 8 or 9 days. I want to stress several times today that it is not a first in, first served, a first come, first served funded program. So you have until the 8th of January, 9 days in order to get in. So we will go through that. We're going to look at the Consolidated Appropriations Act. You know, just when we got used to the CARES Act being a nice, simple acronym, now the new stimulus is part of the Consolidated Appropriations Act. 1.4 trillion to keep the government running for the next 9 months. And then also a little thing called a stimulus package that has been negotiated the last 5 months. So we'll talk about the stimulus again, and we have a little bit more information to share than last week, and we'll continue to get more information in. We'll talk about what I call the big 5 winners for businesses as far as the stimulus items go. And there's some very different and unique ones, some different twists and turns on even going back to changing a lot of the regulations or some of the regulations to do with your first PPP loan if you received one. So we will talk about PPP and the new changes, including those nonprofit C6s that can now get in and some other things. We'll talk about forgiveness, some of the changes and expenditures that have changed, the new regulations with forgiveness. And again, you know, we've been sharing this timeline for those of you that have been around with us for a while, for quite a while, and that's the PPP forgiveness timeline. And the very earliest PPP grants we started seeing around clients getting them, it was maybe around the 12th of April. Those are not due for forgiveness. Your forgiveness application for the very earliest PPP loans are not going to be due until sometime in May. So if you got yours later, it kind of corresponds out over a longer period of time. But again, the key point there is PPP forgiveness is out there. And, you know, some people might benefit by having waited. We'll wait and see. So gone, as of tomorrow night at 9 p.m. is the SBA, the U.S. Small Business Administration's disaster loan, the EIDL program, Economic Injury Disaster Program. There is still time to get an application in. There's still funding for the program. There's still an opportunity to do a reconsideration, but you're really pushing it now. We have till 9 p.m. tomorrow night. And then the EIDL loan, the full-fledged EIDL loan that originally was up to $500,000 back in March, and now the largest amount is about $150,000, and has been that way for most of the open period, will be gone. Also, gone tomorrow is your last chance to apply for the loan program, the Main Street Lending Program. And the Main Street Lending Program is the one that is not being renewed. It was scheduled to end the end of this year, $454 billion program. It's got a lot of interest, and there is some breaking news on it to report that they will continue to process applications through January 8th. So if you've been working on a larger loan program, like say one through the Main Street Lending Program, which is now, I believe, up to about $14 billion of what they've had loan proceeds funded out of as of last Wednesday. A far cry from the 454 that was appropriated, but who knows, maybe some way, shape, or form it'll come back next year. We have a special guest today, Dr. Richard Gearhart, who's a professor of economics at CSUB, CSU Bakersfield, and he will be providing some great insight on what we had talked about on how effective is the stimulus program been, and also some stuff on some of our harder hit industries. So what's up today? Well, tomorrow it's bye-bye 2020. I'll let you fill in the blank. It's been blank. So I think we'll get a wide range of answers if we were to seek answers to that question. Could be all over the board. Have a lot of questions I know that you're going to have. Got a lot of them emailed to me already. So please put those in the Q&A box. We will hit the Q&A box and be here. I anticipate this webinar running over the hour. It's kind of like has the feel for some of those earlier ones when the funding programs came out. And there's a slew of questions and there's a slew of information to go over. And there's going to be so many words on so many of these slides. I apologize in advance. So put your questions in the Q&A box. Also, if you have a question afterwards, don't hesitate to email me. You'll see my email attached to some of the e-blast email messages that you received or signed up. So questions afterwards, we will be around to answer them. So that, and we have our poll. So just a real quick poll, straight to the point, 2 questions related to PPP. And what we're doing is a little research. I think the economists like it when I do economic research and also find out what's happening locally, if it's comparing to the federal standards. And a question we've asked earlier was, did you initially receive a PPP loan? So we have 2 questions here. Did you receive an initial PPP loan? No, I did not apply. No, was not eligible. Yes, 150 and under. Yes, 150 to 350, and yes, 350 and over. And the second question is, do you anticipate applying for PPP, either voluntary or involuntary by not being able to be one of the select criteria that the powers that are using to go back for a second helping of PPP? So 2 quick questions. Did you receive the initial PPP? Either no, you didn't apply, you weren't eligible. Yes, under 150. Yes, 150 to 350. And yes, over 350. Also, question 2. Did you anticipate applying for PPP2? Yes or no? Simple. Yes, no, or maybe, excuse me. So, okay, well, we're going to we have about 65% of you in. Pushing that 70% mark that I like to see so much. Stuck at 69, but we had nearly about 140 of you are in. So let's end the poll. Let's end the poll, and we're going to share the results with you to see who all is here today. And the overwhelming are yes, you applied for a PPP loan. and it was 150 and under. And that's probably pretty consistent with a lot of the economic data that we got from the initial round of the PPP. So 55% of you say yes, you've received a 150 and under. Then it goes to no, did not apply, which was 19% of you. 11% was 150 to 350. Did not apply because you weren't eligible was 8%, and over 350,000, 7% of you. Thank you. And part two of that was, do you anticipate applying for PPP2? Majority, 51% of you say yes, 28 or maybe that hinges on some of the information we talk about today, and 21% say no. So thank you for that input, very valuable input, and kind of helps us guide this ship a little bit today. I'm going to stop sharing the results for that and start moving along. And our first thing today is the California Relief Grant, which can be found at CA reliefgrant.com. And the opening round for this program began this morning at about 6 o'clock. It'll run until January 8th, 11:59 p.m. I can say at 6:12 a.m. they were open, and I was putting in, I apologize, I was putting in my little bit of a sample, a little fictitious program. No fraud. I'm not trying to really get one of these loans. I'm trying to find out more about it and more about the portal so I can assist businesses. So a little bit about this grant program. It's $475 million, almost $500 billion. And it's coming out of the California Office of the Small Business Advocate. The program that they're using is a CDFI, a community development financial institution, Lindustry. And Lindustry is based in San Francisco, founded in about 2015. They've done a program like this in Pennsylvania already. I believe it was about a $300 million program. So they have a little bit of history there, and intend to be a CDFI that's rather well connected in the fintech area, which is really, really solid. So what we're looking at is at two rounds of funding. Mentioned the first round that's open now, $237.5 million. Again, this is not on a first come, first served basis. There is an algorithm that will rank these. And since this is anticipated to be oversubscribed, where we do anticipate more applications than there is money available, it will be competitive. How competitive? My colleagues say anywhere between 2 to 4 to 1. So somewhere in there, there's what you see are the eligible gross revenues. You must have at least $1,000 in revenue and cannot have a gross revenue greater than 2.5 million to apply. It's slotted between the amount of your revenues and the amount of your grant, with the biggest being the 25,000. And if you're 100,000 and less in gross revenues, your amount would be a $5,000 grant if you are successful. So two types of entities that can go after this are small businesses, and that includes sole props, independent contractors, people who receive 1099s, for-profit businesses of any legal entity, based on the fact of 2.5 million or less in revenues, based on your most recent tax return, either 2018 or 19. Also, they do have a small nonprofit category as well, where they're accepting applications for 501c3s, 501c6s, to the tune of about 2.5 million and less. Also, Form 990, which is essentially your nonprofit income tax return, so to speak, if nonprofits paid income tax, but you're filing with the IRS annually. So those are the two groups that this particular funding is open for. As you see that there's a number of eligibility requirements that you must make. I'm not going to go through all these today in the interest of time or lack of it thereof, but a lot of things that can be done. We've already put together earlier today about a half hour, 31 minute in more detail. It's going to be an on-demand webinar, on-demand briefing of a lot of the same information, but in much greater detail. So look for that if you want more information. And here's a number of the ineligible businesses. You can always go to the website, careliefgrant.com. When I went to it a little bit early today, it worked fine. You go through a partner. Maybe we'll jump into it and try to see. But when I went to it about an hour ago, it was being, I believe, overrun. Definitely whelmed, if not overwhelmed. So ineligible businesses, no speculative businesses, none of the SEN businesses, gambling, sex type businesses, etc. If any of the owners had a legal judgment against them, convicted of anything else, or any form of parole or probation hanging over them, own 10% or greater, they will not be eligible in this program. Some of the other quick things about the program include the use of funds. So the use of funds include all employee expenses, payroll, associated cost with payroll, working capital, overhead, reopening expenses after the state mandated closures, complying with COVID-19 requirements, PPE, testing, outdoor dining supplies, barriers, plexiglass, etc. All eligible uses, and you must identify. So if you get a $25,000 grant, you cannot just put it into your checking account without identifying expenses that grant went to cover. So there are eligible uses of those funds, and that is what it is there for. So please keep that in mind, that they do need to be earmarked, and they cannot be used by expenses that have already been covered, say by a Kern Recovers loan, a PPP loan, or an EIDL grant or advance. So a little bit about the application is there are 2 rounds. Told you the dates for those. Round 2 has not been identified yet. There'll be a couple of stages in here, and there's some information that's going to have to be uploaded. You're going to need to complete the application on the online portal that is provided by Lindustry. You'll select and need to upload some financial and organizational information and a variety of other things. So be anticipating the need to upload a PDF copy of a tax return, a PDF copies of any articles of incorporation, fictitious business statement, etc. They're going to great extent, it seems like, to try to cut some of the fraud that was in some of the earlier programs, most of them on the federal side of things. So there you go. There's a little bit about the program as far as application stage goes. I know you want to know how do you rank in this? Because again, it's going to be oversubscribed. It's going to be competitive. So the businesses that are going to be, it looks like targeted, are going to be those that have showed the greatest loss in gross revenue. So we have revenue losses, and you know the businesses. There are sit-down restaurants first and foremost, including retail, and also hotels and hospitality industry, health and wellness, and personal care. Your beauty, nail salons, spas, and barbershops. All of those directly impacted significantly, but also those that are also been affected by the stay-at-home orders. So it could become regional. Right now, the biggest stay-at-home order affects Southern California and the San Joaquin Valley. So does that mean that we are in a more competitive situation? I guess we'll wait and see. Kind of sounds that way to me. And then lastly, the number 4 one is underserved small business groups. So there is women-owned, minority persons of color-owned, and also veteran-owned businesses that are 51% owned, or businesses that are in low to moderate income areas as probably defined by a census tract, or rural communities. And fortunately, you have that website to go to with a lot of the same information. You will receive a notice of funding of the award when it is funded. A couple of quick tips I want to give you that are really, I think, important. Throughout the entire process, please use Google Chrome. Now, I don't own any Google stock that I'm aware of. Probably do somehow, but I'm not really making that plea for that reason. But Google Chrome works best with the platform, and other browsers tend to have a tendency to disrupt the application process and even throw people out of the room. So Google Chrome on a computer, be it a PC-based, Mac-based, whatever, seems to be the best way to do it. Okay, so there's your California grant small business program that we've been talking about. The first bit of the $500 billion that's coming out. Guess it's not quite $500 billion, but anyway. So let's jump into the Consolidated Appropriations Act. And in there was, of course, the stimulus package that we've talked about a little bit and talked a little bit about last week. Let's get into a few more of the details that have come out. The big five for me, the big five things for business in the stimulus, this is number one, is going to be now what they're calling the second draw, a PPP for qualified firms. And again, we'll get into what is a qualified PPP firm, but also we will look at some of the changes that were made, some of the changes for forgiveness and for the application process that kind of affect even the last PPP. A little bit more information on the events, theaters, venues, museums, etc., that are considered to be shuttered venues. There's 15 billion available. We'll look at that real quick. EIDL advance is now forgiven. So if you listen to us for 40 weeks talk about how your EIDL advance was going to be not forgiven and you were going to have to pay that back, or as some of you that are out there today probably already paid back, there's now a provision where that is not going to be the case where it's going to be repaid, and it is now forgiven. If you've already paid, we'll be waiting for guidance to see if you can get back the money that you already paid. And there's going to be new EIDL advance, not a new EIDL loan, just the EIDL grant program. And then also the tax deductions that were allowed for PPP used in your first PPP, that was one of the big elements in there as well. So some funding and actually some still kind of cleanup work from the past bills. So again, there's our stimulus that was officially signed into law on 12/27. I think that starts the clock for our friends at the SBA to start doing some guidance according to the act, where they get to now create forms and create more guidance and rules that we will be talking about in the coming weeks. And there it is, $325 for small business. We had the direct individual stimulus checks that created quite a bit of drama over the last week, additional unemployment, and then a number of different other expenditures, as you see and have probably already heard about. So let's jump to PPP2, the second draw of PPP. Again, that's going to be for our hardest hit industries with 300 or fewer employees, and that they can demonstrate that they had a sales reduction of at least 25% in any quarter during 2020. And that would be corresponding to the same quarter in 2019. One of the new ones that come out that I missed last week was that businesses that are entities with ties to China are eligible for PPP2. So that'll be interesting to see how that's defined, and probably creating some hardship for some people, but we'll see how that's defined and how that shakes loose with ties to China as being ineligible for PPP2. And there are set-asides, to increase access for minority-owned and other underserved businesses. I probably railed quite a bit on this when the numbers started coming in the middle of the summer, that the access for minorities, specifically Hispanic and Black-owned businesses, was significantly less than those with business relationships or better business or banking relationships, something along those lines, and that for whatever reason they were not accessible to the extent that others were. So there's monies being set aside and efforts being made to reach that particular group, which includes veterans and rural businesses as well, and creates a set aside for the very small businesses with 10 or fewer employees in distressed areas. And also expands not only into nonprofits, 501c6s, but also expands into more access for hospitals, local newspapers, media sources can now apply for PPP. And if you're applying for the first time for PPP because you weren't able to before, it is a similar process than what everybody went through with PPP1. And you would go through that particular process as will be detailed by the SBA sometime soon. So we know now that we're looking at 2.5 months of payroll from 2019 for restaurant and hospitality industry, 3.5 months. So the difference on that from 2.5 to 3.5 months for your hospitality is if you received $100,000 PPP with 2.5 months, at 3.5 months, that would be about $140,000 PPP. So really kind of ups the game really significantly in that area for those distressed businesses that qualify as restaurants and hospitality industries. So we also get to add PPP expenses and cost. And so some of the forgivable expenses that we talked about as far as payroll and other things, we had PPP expenses. It simplifies the process for 150,000 and less, and repeals the advance that we had talked about. And then, oh, no, can't skip that. That last one is seasonal employers, because we have a lot of seasonal employers utilize payroll costs for a 12-week period anytime between 2/15/19 and 2/15/20, which is a more favorable treatment and periods to actually apply for than was the original PPP1. Quickly for grants for shuttered venues. The big things I want to get here is we talked about the 15 million, but we know the grant awards now are going to be the lesser of 10 million or 45% of your 2019 gross receipts. So it's really coming down to, since you cannot combine a grant for shuttered venue with a second round of PPP, for those of you that are with, say, museums or music venues, comedy clubs, etc., theater, movie screens, you name it, you're going to need now to look at and see what is going to be the best road for you to take. What is going to be better? Is it going to be the 45% of your 2019 revenues or a second round of PPP? Assuming that you meet the other requirements. So on as far as forgiveness goes, forgiveness on the old PPP grants, as I say, we still got 5 months. Probably don't need to get into this a great deal today. Just a little bit that there are other expenditures that now count, but you still need to hit that 60% for full forgiveness for your payroll. Payroll still needs to be at 60%, even though there are other expenditures that you can now use to fill in that 40%. There's your EIDL grant, the new EIDL grant. And again, that is going to be the difference. So if you received a $2,000 EIDL grant last year, you now will be able to apply for up to an $8,000 grant, which would be fully forgiven as a grant, and a variety of different uses and individuals that can do that. You do need to come from a low income community as defined right here, 80% of state average as far as income. Get into the tax stuff real soon, but there's a lot of things just to touch on real quickly, like the expanded employee retention tax credit. It's really in play now because people who received PPP last year couldn't apply for that. So it's been expanded. It looks like it's been made into a better program. We'll talk about it soon. The state, we'll talk about it next year. It's so next year right now. Under this bill, a family of four would receive $2,400 in direct payments. So there's that. If you go another route, a single mother, who really a direct payment is made for, in my opinion, a single mother with two children is going to receive $1,800, $600 each, whereas in the last CARES Act received $2,200. So there's your difference that is part of the controversy that everybody's talking about. And as I blow through this stuff, we have unemployment, and I know some of you took advantage of the self-employed unemployment that was available last year or this year for the first time. And we also talked a good deal about broadband. There's a lot of conversations going on with CDI and minority depository institutions that are kind of reaching out. A lot of things going on in the SBA lending route. If you received an SBA loan previously, be it an SBA 7A, 504, or one of their community advantage products, Keith Price talked a great deal about this last week, and there's some good things on that. So, wow, right on time. Okay, I know a lot of stuff to cover, lots and lots. We're going to have a lot of materials available to you. Keep your questions coming. We need some questions. We'll get to those at the very end. And again, we very well may run over a little bit. But the beautiful thing is, feel free to leave. Our special guest today, it's a privilege to have Richard Gearhart join us. And Richard and I started talking about this a few weeks ago, and it's changed dramatically since what we had originally talked about. I got to really hand it to Richard. Richard is joining us on a CSUB holiday. Most of you know the campus closes between Christmas and New Year's, but the reason it closes is because they move key holidays such as President's Day. That's coming up in, about another 8 weeks, 6 weeks. We move those to make a better flow for instructors like and professors like Richard, who will be Zoom in the room zooming on President's Day this year. So I know today is our Columbus Day or Indigenous Peoples Day. So Richard, thank you for joining us first of all, and let me say that you are an associate professor at CSUB, School of Business and Public Administration, in the economics department, and came to us in 2014 as an assistant professor. Was promoted recently to the associated professor role. Received doctorate and master's degrees from Clemson University. I thought they only taught football there, but where he taught standalone econ classes as a graduate assistant for 3 years. He's a member of the CSUB Academic Senate that will not be having anything to do with the direct payments regarding the stimulus. Frequent presenter locally, economic trends, published many papers, lives in Bakersfield with his family. Richard, thank you for joining us. It's great to have you. Let me give you controls of the screen and you take it away.
Thank you, Kelly. I'm ecstatic that this is the 42nd webinar. Congratulations, a well-deserved milestone. I'm disappointed about two things. The first, that we're still in a pandemic on number 42. And the second, that you apparently consider me at best the 42nd most important person to contact for these webinars. So let me pull up my presentation. So what I want to do today is I just want to talk for the first 15 minutes about the effectiveness of the previous stimulus package. I pulled together 3 of the better research papers out there that summarize kind of how effective the stimulus has been, how effective our regulatory policies have been. And I want to spend the last 10 to 15 minutes talking about some of the local impacts on consumer spending and on hopefully restaurants and food services. So the first paper, the big picture, I'm going to show a couple of slides with pictures and interpret them. But the big picture from this first paper is that under current economic policies, what we've seen so far across the United States, the pandemic has cost the average US household about 3 months of income. That's quite significant. We're about 9 months into the pandemic. So about a third of household incomes have been eradicated. The authors estimated that sort of a laissez-faire approach would be associated with about 2 months of lost income, but with nearly 500,000 more total deaths. So if you think about it, there's really no good solutions. The largest welfare costs, the biggest losers, accrue to households in the middle of the income distribution. It occurs because they don't get the fiscal stimulus like lower income individuals do. They don't have jobs that are as easily moved to home like higher income individuals do. And of course, when you think about the increasing tax burdens that they will likely face with the debt and deficit increases that we are facing, they're going to face the highest increasing tax burdens. But even under a laissez-faire approach, where it's kind of just live and let live, service-dependent industries, restaurants, leisure, hospitality, the ones that we've seen hard hit would be still the main ones impacted. The CARES Act, so the previous act, mitigated welfare losses by about 20%. So instead of 3 months of lost income, they only lost about 2.5 months of income. So, not significantly large, but still large enough to have an impact for families who are facing rent insecurity. The biggest gainers of the stimulus were low-income individuals. However, they did lose the most initially. Businesses were the second biggest impacted group, that followed by middle-income earners and high-income earners. And the authors estimated that probably a better policy would be allow restaurant workers to work, but to redistribute money to these sectors for inevitable sickness and death. So basically government-sponsored insurance to provide workers at restaurants who would get sick inevitably from working, with a little bit of maybe heightened unemployment benefits, those sorts of things. And so I want to pick out 3 of the best kind of figures from this paper. So you can see all these fancy figures, looks kind of cool. Let me interpret this for you. So laissez-faire policies would have basically saved $1.5 trillion nationally in lost income, 1.5 trillion. US economy, anywhere from like 16 to 20 trillion. So that's a pretty sizable savings. However, in terms of the value of a statistical life, it would have cost the US about 1.9 trillion in lost death value, lost productivity. So laissez-faire, good policy on the face of it. It had some pretty high mortality burdens. Of course, this ignores other costs, but it highlights difficulties. As we're starting to see, substance abuse has been higher during the lockdowns. But as we're also starting to see, it's not necessarily the mortality impacts from COVID-19, but the morbidity or sort of illness impacts, sort of these long COVID symptoms that people even 8, 10, 12 weeks out of the infection are still feeling. You can compare this to if the authors estimated if we were to go into a 17-month lockdown, the economic costs to lost income would be 8.8 trillion. However, we would have saved 7.3 trillion in lives. So you see that the longer the lockdown goes, inevitably, we do see some savings from reduced mortality, but the burdens on business and especially low-income individuals would have been unsustainable. Here's just another figure. The orange line is kind of employment under a full lockdown. The blue line is employment under a laissez-faire. And so regardless of what happens, there would have been significant employment losses for food service workers. The authors actually found using open table reservation data that the week before lockdowns were implemented in many states, most customers reduced their foot traffic quite significantly. So restaurants saw a decrease in foot traffic of about 50 to 75%. So regardless of what would have happened, just by the nature of the hospitality and leisure industry, being around people, perhaps unmasked or in close contact, employment losses would have occurred. In the long run, employment losses would be nearly similar, about 6% fewer employees compared to pre-pandemic. So if we're looking at it, yes, the lockdowns have caused hardships, but these hardships would have occurred regardless. These are just a variety of incomes. The blue line is if there was no stimulus. The orange line is just individual stimulus. The green line is adding the business PPP stimulus. And it appears that other than saving lives, the Payment Protection Program, the PPP, was ineffective, poorly targeted, and not enough. It did spike labor income initially, but in the long run, those benefits have not accrued. So what I want to focus now on is a paper that focused on the impacts of the PPP specifically. So this is another paper. Chetty, Friedman, Hendren, Stepner, and the Opportunity Insights team, they actually got private data from a lot of restaurants, a lot of businesses. Big picture, when the pandemic started in March 2020, high-income individuals chose to remain at home and basically not go out. So high-income individuals reduced spending sharply. especially in areas where in-person interactions were required. And there were significant revenue and job losses of low-income workers in affluent neighborhoods. Basically, spending cratered, especially for small local businesses. What we've seen is that high-wage workers have experienced a V-shaped recovery. So that's kind of that quick rebound that all economists were hoping for. On the other hand, low-wage workers are still recovering. So they did not experience a V-shaped recovery. Economists are now calling this a K-shaped recovery. The state-ordered reopenings of the economy, when we kind of had those reopenings in May, June, July, they had small impacts on spending and employment. So people really still did not go out. They were still very cautious about the impacts of stuff. We know that the fiscal stimulus increased spending for low-income individuals. I will put it on. Sorry, 1 second. Let me put. Okay, sweet. Let me put on your necklace, okay? Then let Daddy just finish up, okay? So the fiscal stimulus increased business spending for low-income individuals, but little of the spending actually flowed to businesses impacted by the COVID-19 shock. A lot of it went to building up a little bit of a savings buffer. A little bit of it went to paying rent and other debt. Very little flowed to local businesses, which is what we want to see during a fiscal stimulus. And unfortunately, the PPP loans increased employment at small businesses by 2%, but that implies a cost of about $400,000 per job saved. So just incredibly ineffective in how it was targeted, which will hopefully be resolved with PPP2. The big conclusion of the paper: consumer spending has been constrained by health concerns. That's the guiding factor in determining what consumers are doing. So again, cool little table that they provide. What do all these numbers mean? Basically, in-person services, so that's restaurants, bars, beauty salons, barbershops, nail salons, gyms, those sorts of things, are still significantly behind January numbers. We've seen revenue reductions of about 50% in total, which is massive, especially when you consider the operating margins for a lot of small businesses. And unfortunately, a majority of the decline in the in-person services are coming from hotels and food, two of the most visibly impacted sectors that we've seen. So again, just another table. Again, what does this table mean? From the fiscal stimulus, low-income households had a 27% increase in consumer spending due to the original CARES Act. That's massive. Again, remember, we saw about a 33% decline in household income from the early lockdowns. So the fiscal stimulus nearly eradicated this. High-income households had only an 8.45% increase. That's largely unemployment payments. Unfortunately, business revenues increased by less than half of consumer spending in low-income areas. So either low-income individuals are choosing to buy from the larger stores, or perhaps Amazon, which doesn't necessarily flow to the local communities, and they're stopping shopping local. And we see the same thing with high-income individuals, where business revenues actually decreased in high-income areas. In high-income areas, people essentially stopped going to local businesses and engaging in foot traffic, which is incredibly detrimental. So again, we need more fiscal stimulus. We need more help. And so if you look, this is the orange lines are retail sales, total retail sales. Sort of these green-blue lines are food and hotel sales. And so again, what do we see? Retail spending has remained strong. We'll see why in a second. In part, it's because of increases in grocery store and food outlet employment, and foods and hotel spending has cratered.
Where's my wiping? I lost it.
Okay, I will look in a second. Please shut it. Okay, I will look in a second. Okay, Claire. Okay. Okay, I will get it in a second. And so if you look at this figure breaks down consumer spending by a variety of different services. And you see where people actually increased spending was at-home swimming pools and landscaping and horticultural services, knowing that if they were going to be spending more time at home, they wanted better amenities. Consumer spending plummeted, restaurant, airline, barber, and beauty shop spending plummeted. So again, spending on home amenities has increased, but total consumer spending has fallen by nearly 25%. And consumer spending is the biggest part of economic GDP in the United States. That's about $2.8 trillion of lost economic value. Restaurant and eating place consumer spending has fallen by nearly 70%. That's $650 billion lost just in restaurant economic value. That's tremendous. That's a large hole that will be difficult to dig out of without massive additional help. Last paper, did the payment protection program hit the target? This is kind of what we want to know. Well, local banks played an important role in getting money for their clients. Unfortunately, it means that areas that are less affected still received monies. So the short and medium term employment effects are small relative to the program size. So again, kind of the biggest complaint about the PPP was that it was less effective than it should have been. And unfortunately, many of the firms that shouldn't have been given money but did receive it used the loans to make non-payroll fixed payments and build up savings buffers. So there was ineffective targeting to businesses that needed it. It was a nationwide failure. And so again, a bunch of pretty pictures. What do these pretty pictures summarize? Business shutdowns are still high, unfortunately. That's kind of the nature. The PPP was not enough money. So PPP did reduce it, but not as much as it should have. The payment protection program did help offset business revenue losses, but not enough. Again, another pretty picture with similar conclusions. In total, it appears that the payment protection program did not impact business shutdowns and had a temporary impact on business revenues. It was highly ineffective. It needs to be better, especially now that we're going into 9 months of a pandemic, with January being estimated to be the worst month in terms of kind of the COVID outcomes. So that's kind of a summary of what other researchers have found. So big picture, fiscal stimulus helped. The PPP was effective, but it was ineffectively targeted. We need more stringent guidelines. And right now, consumers are shifting their purchasing patterns. So while there is some loss in economic activity, consumers turn to more luxury purchases to weather the pandemic at home. So a lot of these changes will be short term, but that doesn't help businesses who are struggling now. So let's take a little bit more micro look. Let's look regionally. Let's look at Kern County and Bakersfield specifically. So here are just employment changes in California and in Bakersfield from January 2018 to November 2020. Those are these first two columns. The last two columns are March 2020, the beginning of the pandemic, to November 2020. And so if you look, total non-farm, the top row, there's actually been modest employment losses in both California and Bakersfield. But if you look at kind of these last two rows, food service and drinking places and restaurants, we see that in Bakersfield from January 2018, about 1 in 6 food service and drinking jobs have been lost. For just restaurants, that doesn't include bars, 1 in 7 jobs has been lost. So that is, again, unsustainable. If you look March 20 to November 20, it's 1 in 5 jobs being lost. That's just completely unsustainable. Unfortunately, while we hope that we could attribute all of this to government shutdowns and government lockdowns, we see similar outcomes in other states that are much more laissez-faire approaches. So at the bottom, you see similar changes in Texas, which is considerably more laissez-faire than California. So local impact snapshot, Bakersfield has been much more impacted in the recent COVID recession. It's due to the lower income nature of the area. We have a lot of jobs that simply can't be performed while at home. So unfortunately, we suffer because of that. Compared to January 2018, Bakersfield is in a better place than California, but it's because of the amazing growth we've seen in Bakersfield over the past 5 years. Unfortunately, all of the gains in growth that we've made, sort of that catching up to the California standard, has largely stagnated during COVID-19. And again, unfortunately, more laissez-faire areas have economic harms that are similar to those in California's. So it's not a government recession. It's a recession caused by a perception of health harms from undertaking regular economic activity. It is government exacerbated. And so this is something that we really don't know how to solve. We have recessions from consumer demand or producer supply, but we have not faced a pandemic recession in over a century. So this is something that is completely novel that policymakers are still scratching their heads to figure out. Well, if you look, here are real personal consumption. Here's spending. Here's personal spending in Bakersfield based on a variety of different sectors. So the blue is food services. We see that cratered by April and has caught back up, but has largely stagnated. Again, it's a recession caused by the perception of the health harms that's exacerbated by government activity. If you look at meals and alcoholic and non-alcoholic beverages, this orange line, that's a majority of restaurant sales. But if you look at kind of this red line, which is alcohol and purchased meals, which is where some of the bigger profit margins exist in the restaurant industry, that's flatlined. So it's a struggle. So again, if you look, we see that since between January 2020 and November 2020, basically $1 in $6 has been lost in the restaurant industry. $1 in $6. That's massive. A lot of restaurants can't sustain those types of losses. Well, we've seen some catch up between March and November, but food service sales are still 4.5% lower than what they were. Meal sales, 4% lower. Alcohol sales, 6.5% lower. The average profit margin for a full service restaurant ranges from 1.8% to 1.8% to 6.1%. So if food service sales are 4.5%, a lot of restaurants are no longer anywhere close to being profitable when they may have been so just a few months earlier. So I kind of want to end this thing. Okay, we're looking at some of the bad. Why should we look at some of the positives? So here's food service employment. So again, you look at that big crater. That was the beginning of the pandemic. So though employment has cratered, the gains of the last decade have been erased within a year. Rapid regrowth of the industry is possible. Why? Well, existing spaces don't need to be retrofitted. There's still a qualified workforce where even 1 in 6 restaurant workers is no longer working, but they still exist. They still live here. So there's a qualified workforce. And hopefully with these newer rounds of stimulus, with potentially another one coming in the next 100 days, there's some potential for lower market rates or reductions in rates on big ticket food service expenditures, rent and equipment. So there is some positive where we can catch back up. Again, why positive? Well, this top line is total personal expenditures in Bakersfield, but total consumer spending in Bakersfield has actually increased by 2% since January of 2018. It's higher. So yeah, we are missing out on that lost economic growth. And most of the management of the loss has been high income earners, and low income earners have been supported by fiscal stimulus. But we haven't lost so much income that we can't recover. We can recover. As I mentioned, a lot of consumers are switching their spending patterns to support themselves at home. So we just need to see a natural evolution of that. Well, here on the bottom, this blue line is takeout food spending, And this orange line is kind of sit down restaurant spending. So takeout food spending increased by nearly 11%. In-person dining spending has fallen by 17%. So again, there's still loss in restaurant spending. The rest is explained by people going to the grocery stores and eating there. But consumers are still supporting local restaurants. They're still eating out. They're just choosing to take the food back home with them. A lot of restaurants aren't built to deal with that dining model, but the demand for local restaurants is still there. They're just being held back in large part by health concerns. Why positive? So this is another paper, private precaution and public restrictions. So those stay-at-home orders have limited foot traffic to the restaurants. The authors found about 75% of the decline in foot traffic was related to people just choosing to not go out, private precaution. So it does not capture the most recent surges or stay-at-home orders, but the analysis is likely to follow a similar pattern. So again, what does this mean? The recession so far is mostly a consumer-driven one, government exacerbated. So we see that there are changes in spending patterns. We haven't seen a destruction of wealth for consumers. We've seen basically a supporting consumer wealth, but consumers are changing their patterns. So the demand for restaurant food is not fallen, it's just changed. It will come back. We also see that there should be some positives because it's a change in mobility patterns. These are consumers choosing to alter their behavior. So again, once things start to look better, once there's a better positive outlook, consumers may actually return to the restaurants. So if the recession is mostly consumer driven, then these developments may be a positive for 2021. The vaccine. My wife received her vaccine last week. It's a wonderful thing. Everyone should get it. Further fiscal stimulus. It should be more targeted with the potential for higher personal payments. There's also limits on luxury home spending. You can only have so many pools in the backyard. You can only have so many couches in a house. So consumers have spent on the luxury items. They'll probably start coming back to the local spending patterns. And people are still catering to the restaurants. Again, they're choosing to eat more at home, which is not good for the current setup of many restaurants right now, but it does hint that the demand for this product is not dramatically diminished. So thank you. I kept myself on time. Look at that.
Well, thank you, Richard. I got a question. We got one question here. When you showed the huge drops in the food, restaurant, and other sector, also there was an equally huge drop in gas and oil. Is this because of travel was reduced, or does it have something to do with the price of oil or some other factor? And you're muted.
Yeah, I have to unmute myself. That's what happens. So it's likely just a correlation, so one didn't drive the other. But it's similar things that we were seeing that kind of depressed restaurant activity, reduced mobility, reduced travel. If you saw the news recently, one of the major airlines, I think it's American Airlines, are bringing back 60 of the 1,300 furloughed pilots. So there's just a reduction in demand, which reduces the demand for oil, depresses those prices. So we should probably see similar trends. We might see travel increasing a little bit before foot traffic in local restaurants. So you might see oil prices leading the rest of the economy.
Okay, well, that's the only question I have for you so far. If you have a question for Richard, go to the Q&A. I'm going to jump in and answer some of these. The first one, some of them that were emailed to us that I remembered to print out. So the first question is, can a physical location be a UPS store address? And that's for the California Relief Grant. And that is a very good question because it does say that you need a physical location. Now, I would probably go back to what location and what address you show on your tax return. So I think it's key to be important, but I know that they're going to be using potentially GPS and others to track these locations. But hopefully that's something that you can get figured out early. The one thing about this is what we're going to find is like with PPP and other programs is that there are so many variations to businesses and there's so many different little nooks and crannies where things are going to get slipped and going to get lost dropped in the cracks and so forth. Whatever allergy I can butcher right now. Also, we're getting a lot of people who are trying to go into the California Relief Grant.com site and are finding that it's very slow. And this is something that we kind of experienced with some of the other relief programs in California, well, across the country with the EIDL program and even PPP. So what I think you're seeing is you're just seeing overwhelming activity. Early on in EIDL, we were suggesting that people would go on between midnight and 6 a.m. in order to apply. Now, hopefully after this initial rush goes through, you'll be able to get in. But I was in early this morning and I started to do, I was hoping to go back in earlier or later or today, but we'll see. So if you're having problems, keep trying. Keep trying. Okay, next question. Our gross revenue is more than 2.5 million as a nonprofit here in Kern County. Our revenue is fixed, but our expenses are escalating. Can we apply? And you probably are correct. You're probably not going to be able to apply. It's going to be a fixed amount, that 2.5, and I don't see much hope that they're going to really do much to change that. Okay, here's a question regarding PPP forgiveness approval. Do you need to have it on the first PPP before applying for the second round? That was my previous understanding. And, that was probably something we talked about because we were getting feedback that it could be a condition of the second PPP. The fact now is that you have three large banks that are really behind the curve as far as getting their loans forgiven. So I don't really think it's feasible to have the first one actually forgiven to be part of the process or to be, a qualifier in getting the second one. At one time, I think that was the hope, but I think it ended up kind of going away. Next question. It has to do with Kern Recovers Forgiven Loan. And we had our tax specialists, our CPAs, Lou Barbich and Patrick Hoffman on a couple of weeks ago, just a week before all this happened, of course, which is the way things work. And the question has to do is the Kern Recovers Loan Program, is that a forgivable loan amount? Is that going to be taxable? And, from what we're seeing so far, I will say right now, I don't have a conclusive answer for you. If it was me, I would take the assumption that yes, it's going to be taxable. You're seeing the state of California not have many of their programs are going to be taxable. We had actually the PPP grant originally not taxed, but the distributions and the expenses were not going to be tax deductible expenses. So, you had kind of that going into it until this legislation changed that by an act of Congress. So I don't really see that happening. I know they were CARES Act funds that were down to cities and counties, but I would take the assumption, at least at this point of the game, on December 30th, that it's going to be taxable. Okay, a few of the other questions that we have. We're an LLC that's 59% owned by a trust. What do I enter as the owner's personal information? And this is going to be another one of those situations where it is so unique and so different that you're going to probably need some type of guidance. I feel pretty good about Lindustry, about them having the capability of going in and trying to work on unique issues like this. So as an operations manager, you don't have any interest in the LLC. You sign behalf of them. I would think that if you have similar to a corporate authority to sign, for example, if you got an EIDL loan in your corporation, you'll know that you had to provide a document that said that you had the right to sign a corporate resolution on behalf of the corporation. it's one of those things that are unique enough that we'll have to see. I would still go ahead and apply, and I would try to see if your application is going to get kicked back because of the fact that it's 59% owned by the trust. The parameters to qualify for the second helping of the PPP program. Again, that's going to be 25% reduction in sales or revenues, in gross revenues from 2020 to 2019. So if you can show in any of the 4 quarters that you had a 25% reduction, that is one of the areas, that is one of the key areas. And that is really kind of the key one right now. Do you need to upload California tax return along with the federal? Good question. I guess we'll wait and we'll find out. I would think that the federal one would be sufficient, but if you want to play it safe, I know it's a big upload for a lot of people with both federal and state, but I would probably do it. Do we know if the second round of PPP will be 8 weeks or 24 weeks yet? Yes, Cheryl, we do know. The PPP is going to expire on March 31st, the PPP2. So if we do get that going approximately, let's say January 10th, that leaves about 50 days. So to the end of February and another 31. So you're looking at almost 11 weeks probably. So I would say it would be probably 11, 12 weeks, unless it's extended. Can I apply for an EIDL grant now? That information will all be out soon. SBA is in charge of coming up with the details for that. So the EIDL grant will be open fairly soon. And my understanding was SBA needed to come up with information within 10 days after the president signed, which will happen to be next Wednesday, January 6th. Now, it seems like a big task and a lot to ask, especially over the holiday season, and especially since SBA did have kind of a busy year, trust me. So we'll have to wait and see on that. But right now, I'd shoot for January 6th. As far as the form for the new EIDL forgiveness, they were given 30 days on that, from what I recall reading. I'm currently closed due to stay-at-home orders. Does that affect my ability to apply for a new PPP? Well, if your revenue's dropped, it shouldn't have any factor whatsoever. So if your revenue has dropped by 25%, if you're closed, there's a good chance that revenue is dropping. And I think a lot of people are still going to apply or be able to apply because that 25% drop is happening in this 4th quarter right now as we speak. Would sole proprietors have to show a business license for the relief grant? Yes. You need to show something, either a fictitious business statement if you're a sole prop, a business license, maybe a seller's permit might work, but some type of a legal entity for you to transact business will be a requirement. Okay, we are a restaurant, and our covered period, we were shuttered 17 of the 24 weeks. Sorry to hear that, Al. The other weeks, we were at 25%. We were not able to return to our FTEs, which is our full-time equivalents. We were able to spend the grant funds. Well, that's the important part. We used it for payroll and to-go orders, etc. So you should be okay on the FTEs because, number one, if it's 150 and under, I believe you're not going to have to worry about the full-time equivalents and returning to the position. What you're going to have to do if it's 150 or under is to actually go in and just list the number of employees you had. If you're over the 150, it depends on which form, and it kind of depends on how the forms shake out. But I would think if you're a sit-down restaurant, any sit-down restaurant this year is not going to have to adhere to the FTE rules. They're going to be covered by the safe harbor rules, either 1 or 2, which is an exemption around hiring back all of your people. Will we be able to get full funding without returning to our FTEs? You should. You should be able to, again, because of the nature of your business and how of how, basically it's been. It's been a shuttered situation for sit-down restaurants. Oh, loved Richard's presentation, didn't we all? Can I get a copy of this recording? A copy of this recording will probably have even a lengthier webinar where I went in and ran into the same problems many of you are earlier today, along with the links that we talk about, and all that stuff, maybe even a copy of the handout, since there's a lot of verbiage on the slides, will all be emailed out to you hopefully sometime this year, if not very, very early next year, which would be Friday. I expect to have lender guidelines. When do you expect to have lender guidelines available for the next round of PPP for SBA? Well, I think lenders are going to find that out before me. But I'm hoping it's that essentially falls underneath that umbrella of the 10 days from when it's passed into law that SBA is expected to come up with a lot of the guidelines for all the programs that are affecting small business and are kind of under their control and under the control of the Department of Treasury. There is obviously an administration change that's going on now, and hopefully that won't slow things down. Okay, a few more questions here. Is a date for PP2 application submission available? Stay tuned is all I can say to that now. Hopefully we'll have something going, as I said earlier, I'm hoping by the 10th of January, but I would think no later than the 15th of January, but we'll wait and see. Will be processed through financial institutions similar to the original PPP loan. They're calling it a second draw, and I imagine the application process, just from what I've been reading in the law, is going to be slightly different, to where it might be a different altogether. It could be just actually coming out and showing if you're reapplying for PPP2, where you meet the criteria of the 25% reduction and the other things that we talked about. As a nonprofit, we had extra funds coming as donations, but lost due to employee costs, utilities. Will the donations count as gross income? Well, I would say however you treat donations at your nonprofit, I would think it would count as revenue donations. But it's how your accounting is set up and how you do it. Maybe they're in-kind donations and not cash, and you account for that separately. So I would just I would give it a big. I would ask an accounting professional that question. We received the first PPP and have not begun the forgiveness process. Will we be eligible for the new one? My thinking is yes. 4 months ago, I probably said no, but by the very nature of forgiveness changing during this process, the big banks were not really open and going with forgiveness to the scale that just a small percentage of the major banks people have been forgiven by SBA. That I would think you would have to almost have to not have it be forgiven in order to be eligible for the new PPP2. Okay, is the new PPP going to use unemployment as income for quarterly income? I would think that would count. That is a good question. And maybe that'll be defined when the rules come out. But is the PPP, and I assume that this is an independent, well, I know it's an independent contractor who qualified also for unemployment. So my guess would be yes, but let's just wait till the final rules come out. Is it too late to apply for the Main Street Lending Program? You have until tomorrow. Unless you have a bank that's probably engaged and it is a detailed application process, I would say it's probably too late, at least for this year. Can I apply for a second round of PPP if I had used up the first and had to lay off employees? Right now, I would say yes. I would say yes, that you would be able to, just because of how much it's changed. Remember, when this program came out in early April, we were talking about an 8-week window, and then all of a sudden we're on December 30th and still talking about it and still dramatically impacted, if not more so than ever, by the virus. Will SBA be paying the loan amounts on SBA loans as they did with the first PPP? If so, for how many months? I think Keith last week mentioned that it would be for 3 months beginning in February if you have an existing SBA loan. And if you're in a hard hit area, such as a restaurant, and you have an SBA loan, you will have the opportunity to apply for another 5 months after that. So final answer is between 3 and 8 months. And SBA is doing this because number one is during the last recession in 2008, SBA loans were slammed. They were slammed with foreclosures, and the cost for them to go through the process of liquidating those loans, what it did for the businesses and the jobs, it almost seemed like it would have been cheaper just to keep and pay the loans off and to try to keep these businesses going. That really didn't create this pandemic. I'm a real estate agent and investor. I've greatly been impacted by the pandemic. Heard about a grant, the PPP, but because I use Schedule C, I don't qualify. Do you know if there's any grants or PPP that I could potentially qualify for? Well, our state grant was if you had rental income or other income over 51%, you could not. Everything I've heard associated with Schedule E has been pretty much the rental income side of things, which are generally, I think, out. But I will think about that and maybe have something for next week. Will PPP2 be dependent on payroll amounts? Yes, they will be dependent on payroll amounts. And I don't think I shared with you that timeline. I think there's an option of 1 or 2 different options, but we'll cover that in detail next week. I will make sure that we cover the payroll amounts and the payroll times that you can draw for 2.5 times if you're a non-food business, or 3.5 if you're in food or hospitality. Applications not open for EIDL, and that's not an EIDL loan, that's an EIDL grant. And again, if you received an amount less than $10,000, you can actually receive an amount that grants up to that. But again, you have to meet some special requirements in this because of being in a low-income area, which we have quite a few sectors in Kern County, etc. Well, you're very welcome, and thank you for the kind words for Richard. I'll just say they're for Richard. Any communication on what local banks will be accepting PPP2 applications? Right now, Bill, I think the banks are as much in the dark about it as we are. I think hopefully next Wednesday we all find out. It's been 10 days since then. By then, President Trump signed, so we should know. And I hope Merry Christmas, Bill. And I need to talk to you soon. Can you explain more about the new EIDL grant? Yeah. For example, I received a $1,000 EIDL grant, EIDL advance it was called then, and did not end up taking the EIDL loan even though it was approved. How can you go back getting the new EIDL grant? These rules are going to come out soon, but if you qualify, and again, it's been said on this webinar many times, the devil is in the details, so we'll know the details and know more about it. But once that's out, we will be able to tell you if you would approve or qualify, but you could potentially receive a $9,000 grant up to $10,000. Okay. That's a wrap. Richard, it's been too long since we played golf. About 3 years, I think. I got one whole round in this year in the state of Idaho, so I'm due. So we're done for this year. We are going to have the handouts that we send out to everyone. We'll send out a recording of this, probably a smaller recording of the grant program. You do have the link. Go to calcareliefgrant.com when it's convenient for you. I'd like to thank everybody who has been around for today or for all the weeks before, some of the weeks before. It's been an interesting ride, 42 weeks of this in 2020, and look forward to 2021. I got to thank my staff, thank some of the great work that's being done by our assistant at the SBDC, Lynn Gannon, and Maureen Busher-Dang, who has been really a great source and resource, the best marketing consultant you will find in Kern County and probably in several counties, if not the entire state of California. Continues to do a great job helping us get the word out about this. So I think that's a wrap. Richard, thank you for joining us. For Richard Gearhart, I'm Kelly Bearden. We'll be back on January 6th for number 33. Everybody have a happy new year and stay safe. Goodbye now.